Internal capital markets are the distribution of funds within the firm. In theory, it should create value if corporate headquarters is in a better position to allocate funds to divisions or projects than is the external capital market. So the comparison is between, let's say we have two projects. Should these two projects raise funds separately on the external capital market, or would it be better to have these two projects being part of one firm and headquarters allocates funds to each of these projects? And the argument for why it may create value is that headquarters may have better information about which of these projects are more deserving ones, and headquarters also has the authority to redistribute funds, which an external lender like a bank cannot easily do. So whether a firm or, let's say, an external lender like a bank is better able to allocate capital, this is a huge question which goes back to what we call the theory of the firm, which is basically when should these two divisions be part of one firm, or when should these two divisions be separate standalone firms, each financed by banks. And the criteria under which the firm does a better job is when headquarters has better information than a bank about these firm prospects, because within the firm you have better access to information than an external lender often has. And the second criterion is headquarters may also have the authority, or we call it control rights, to take funds away from one project and put it to another one that's better. While a bank can't really take away money from one borrower and put it to another borrower, or a bank can't really tell a borrower, you can't go to another bank.
It's very important when to raise equity. It's important to raise equity in the good times, when banks have lots of profits, when accessing equity markets is easy, and where taking out this subsidy to that will be easier for people and firms. Now, to raise equity in the middle of the crisis, when there is no bank profits, when accessing market is very costly, if banks do that, then the empirical evidence is telling you that banks will cut massively the supply of credit to households and to firms. This will create a reduction in aggregate consumption, aggregate investment, reduction in exports, and this will lead to unemployment and decrease of welfare. So we should do raising capital, but in good times, not in bad times. And then especially here in Europe, Europe is a bank-dominated economy. Banks are very important. If you look at the United States, if you look at commercial banks, all the commercial banks in the United States are altogether 100% of the GDP, whereas in many European countries, only one bank, not the whole banking system, only one bank is higher than the 100% of the GDP. Like in Germany with Deutsche Bank, in France with BNP Paribas, or here in Switzerland with the big two banks, or in Spain with Santander. So what we need also in Europe, apart from higher capital in good times for banks, we need a more diversified financial sector in which it's easy for companies to access capital markets. In this sense, if banks have problems, companies would always be able to switch to markets and then raise finance in order to do investment and to create employment through the capital markets, not through the banks.
It's interesting to talk about cross-border banking in the European Union, and I always make the comparison with the US. And I should, by the way, say this is my own views, not the views of the Federal Reserve Board, where I work for. When we think of cross-border banking in Europe, it's somewhat different than in many other countries like the European Union, like the US, because in the European Union we've had different countries, of course, and we've seen cross-border banking in the form of banks going across borders. But that's different than having banks establish themselves within certain countries, which just means take a bank, Deutsche Bank, going into another European country and setting up a branch or a subsidiary there. We've seen less of that, and that makes for a very different type of banking, and we should keep that in mind when we talk about cross-border banking in the European Union. Clearly before the crisis, we thought of cross-border banking as something that's going to help the countries a lot. It's going to lead to more resources, more investment, and more stability in those countries. After the crisis, we realized that that's not always the case. I think we've seen a lot of benefits from the cross-border banking in the sense that we've particularly think of the countries in the periphery that joined the European Union or the Eurozone only in the last few years or last decade or so. They've really grown a lot thanks to the integration in the financial markets, in the capital markets, and the cross-border banking was an important part of that. That really helped bring resources to those countries that have more opportunities to grow. So it was allocating resources more productively. However, I would say during the last part of the boom, just before the crisis, we really saw some misallocation occurring. Then the resources were going more towards the real estate sector. We've seen it in countries like Spain, in countries like Ireland, or maybe to the government itself in countries like Greece. And that has not been always that productive. That has really, in some sense, led to a misallocation of resources.
So the European Capital Market Union is a new initiative to integrate capital markets in Europe more, remove obstacles to a common capital market, and therefore make the principle of free movement of capital within European Union come true. So the main thrust of the Capital Markets Union is now to develop markets for corporate bonds and for equity stocks, for ownership shares of firms. So that has to be developed. It's also a precondition for credit financing, that you first have own capital and equity before you can get the credit from a bank. So there are the main advantages of businesses and households is that they get access not only to national capital markets but to the European-wide capital market, and that they will meet on the capital market a larger menu of financing options, not only bank credit on which the European economy is very dependent, but also to get access to alternative sources of financing. In Europe we have the problem that not only the banking sector but also the real sector in parts is quite over-indebted, and in such a situation to grow you most importantly need risk capital in order to be access also for bank credit to finance investment and growth. The downside is more on the regulation. I mean, the Capital Markets Union has to be seen in the context of other regulatory moves in Europe, like raising equity standards. In principle, integrated capital markets can also be a source of contagion for the economy as a whole. When things go wrong in Spain, then the owners of wealth in Germany are negatively affected if they own shares in Spain. But whether this contagion is a danger depends very much on the regulation. If banks are sufficiently capitalized, have enough equity, and if businesses have access to risk-bearing capital, then this can be turned into an advantage.